Hello everyone. It has been a while since I last visited my channel and realized I got quite a few messages I did not respond. I try to respond to everyone as soon as I can, but I am sorry if I missed yours. I'll try to catch up. So for this particular one, I actually feel it's pretty hard to explain in just one sentence. So I made a file to explain all these details. Remember, in my private email, I mentioned this is the best time for accountant to learn and use AI. And this is a real example I'm going to walk through. This is a mini course about the capital flows from the accounting prospect. So we are going through a mini cycle of the private equity investment and walk through how to book the entries. I will put this link into the description and you will visit by yourself. This is just a HTML file I dropped in my GitHub. It took only 5 minutes for Cloud to make this HTML page after I told Cloud what to do. However, it took me more than 3 hours to read every single tab to make sure all the data is accurate. That's why I keep saying it's best time for us because AI can build some beautiful, interesting, very useful stuff. However, it has a lot of errors. For people like us, we have the knowledge and experience. We know what is wrong. So we can fix and eventually will be our property. So this is a great example. Let's start from here. So let's imagine you have a little new fund and firstly you're going to get money from the investor, right? So the first stage is capital call. We are going to book the due from, and so we are going to debit the due from before we receive and credit the capital contribution. And then when we receive the money, we will debit the cash and credit the due from. So this middle part has a lot of details you can read, and these are the main entries. And sometimes, actually a lot of times, PE fund only just book the entry when they receive the money. They don't even book the first part. It really depends. And on the right hand side is the financials after every single step. So right now, we do have $10 million received the investors on the balance sheet, and we have not purchased anything yet. So this $10 million is all the NAV the investor have. And nothing happened on P&L yet. And the capital account statement, we have the contribution which contribute to the ending NAV, $10 million. So it's very, very simple financials to start. To the bottom, there is some explanation about ASC 946 and the notes for the model. And now we have the option, we can click the next stage here, then we come to the second step, or we can just keep clicking the stages here. So in the second step, right now we have money and we're going to deploy the money to hopefully get a good return, right? So right now, when we are deploying our money, we're going to purchase the asset, which we will debit the asset and we will credit the cash when it's out of the bank. Then right now, our $10 million cash on the balance sheet before, now only $2 million. And then we will book $8 million fair value for the asset we purchased because we just purchased right now. So the cost equal the fair value. Later, we will book unrealized and realized. But before that, this is what our balance sheet look like. Nothing on P&L yet. And this is the capital account statement, which has no change because everything happened just on this cash deployment. And then now we are going to book the unrealized appreciation. So assume the property we're holding right now has increased the value. So we are going to debit the investment, the fair value appreciation, like $3 million as an example in this file. And then we're going to credit this fair value appreciation into unrealized. And then this unrealized eventually belongs to the investors, right? So we are going to book this unrealized appreciation into our investors' capital account. This is going to have a little change on our capital account statement. So right now, in addition to the contribution we made, the investors has $3 million unrealized appreciation. And our balance sheet, because of the fair value increased by $3 million, this is our NAV. So on the P&L, we have this unrealized gain and loss. And this is the schedule of investment, which is very straightforward. This is a cost, is the amount of money we spend to buy the property, and the $11 million is current valuation. So there was unrealized gain now $3 million. So next one, we're going to try unrealized depreciation. So it's the same type of account, but we just need to flip because it's a depreciation. Now we don't credit anymore. We are going to debit this unrealized depreciation and credit this fair value change. And then next, the same, we're going to flow this account into our partner's capital account. Now our fair value decreased from $11 million to $10 million. Our NAV decreased from $13 million to $12 million. And this is the P&L change. We had like a $1 million loss. So this reflected to the unrealized on the capital account statement, right? And then this reflect accordingly on the schedule of investment. And this is a little explanation. I hope it's very straightforward. And then now we are at the stage of sell the investment to realize some of the gains. So assume we sold this property with $12 million. So remember, we purchased this property $8 million. It increased $3 million, then decreased by $1 million. On our most recent book, this property is $10 million, right? Which means in this transaction, we have $2 million realized gain. So next, we're going to allocate this realized gain into our partner's capital. As a result, since we sold our property, we have $14 million. Remember, we had a $2 million in the very beginning that we did not do anything. In real life, those could be reserved to cover all the fees, but this is very simple to just show the capital activities. We have not added any operation activities, any fees, any complex stuff yet. This is just the very basic one. So bear with me, let's keep going. And we realized again $2 million on the income statement. And then now this is our capital account statement. We have realized again $4 million. And this is our ending capital, $14 million, which ties to the balance sheet, right? And this is the change of our schedule of investment. And then last, we're going to do a distribution. Once you sold all your investment, now you're going to return the money to the investors. Total $14 million we're going to book as payable to our investors and debit as partners' capital. And then now, next is we're going to pay the cash and we will offset our payable. Lastly, in this example, we're going to do a very basic and a simple waterfall. It's a 80-20 split. So we assume GP will get 20% of the realized gain and LP will get the rest. So we are going to debit the return of capital. Remember, our first capital call, we called $10 million from our investor. So we're going to return the money first. Then the rest of the money, we're going to split between GP and LP, debit all these accounts, and we're going to credit the payable. And this is the change of our balance sheet. Got nothing on the book, and no P&L, and the LP capital account statement all shows the distribution, and we got zero on the books. All right. So this is a very simple example to just answer the question Chris asked on my channel. Hopefully it has enough details. This is just additional details about tax because in our real work, we receive a lot of questions from auditors and all from our client about tax. And this little mini session has a lot of details and I feel it's a great way for someone to know fund accounting, the equity part. It has a different card, shows the money flow, and highlight different numbers, and has the stage, has the workflow very clearly on the left hand side, and shows the financials after every single step. All right, so this is a great example about how to learn private equity using a very, very interesting way. Please let me know if you have any question or you want to know different topics